Hello, I'm Robert Kulas, and I'm an estate planning attorney in Port St. Lucie, Florida. Our topic today is the federal estate tax. Now, what is the estate tax? Well, as the name suggests, it's a tax that is levied against your estate upon your death. Now, some people call this a death tax or an inheritance tax, but it's really neither. The federal estate tax is really a transfer tax. It's a tax that is levied against the assets that you transfer either during your lifetime or upon your death. Now, in most cases, it's assets that are transferred upon death. Now, how is this federal estate tax calculated? Well, upon your death, all your assets have a value placed on them. That would include your house, bank accounts, investment accounts, businesses, IRAs, life insurance. All those assets get a value placed on them, and if that value exceeds the exclusion amount, then a tax is levied. Now, what is the exclusion amount? Well, today, the exclusion amount is $5,450,000. What that means is if your estate is under that number, then there's no federal estate tax levied. However, if your estate exceeds that number, then there is a 40% tax on the assets that exceed that $5,450,000 number. Now, who pays this tax? Well, the tax is really levied against your estate, so the assets in your estate are used to pay the tax. What that means is that your beneficiaries will receive less because that tax is taken out of the estate prior to it being distributed to your beneficiaries. Now, if your estate is over $5,450,000, then I suggest that you see a qualified estate planning attorney to discuss the techniques and strategies available to try to minimize or reduce this tax altogether. Now, the federal estate tax really doesn't apply to the majority of Americans. In fact, it only applies to the top 1% of the richest Americans. But for those people that have that estate size, it's important to do the planning. So that ends our discussion on the federal estate tax. Thank you for listening, and we'll see you next time. Bye-bye.